Okay, the live stream has started. Good morning. We're first going to discuss some housekeeping items off the record, and then we'll go on the record where the parties can introduce themselves. Today's oral hearing proceeding for the appeal of PaMaCo Inc. and Pasveer is being conducted in person in Cerritos, California, and is being live streamed to the public. Present is our stenographer, Ms. Alonzo, who is reporting this hearing verbatim. To ensure we have an accurate record, we ask that everyone speaks one at a time and does not speak over each other. Also, speak clearly and loudly. When needed, Ms. Alonzo will stop the hearing process and ask for clarification. After the hearing, Ms. Alonzo will produce the official hearing transcript, which will be available on the Office of Tax Appeals website. Please do not interrupt when someone is speaking. Each side will have the opportunity to be heard, so please wait for when it's your turn to present your arguments. I would also like to remind the parties that the Office of Tax Appeals is not a court, but is an independent appeals body. The office is staffed by tax experts and is independent of the state's tax agencies. In addition, I would like to thank both parties for sending in their list of cases and names. At this time, let me ask, is any party attempting to submit a new exhibit today, starting with respondent?
Yes, we have Exhibit R that we're submitting.
Okay, and what is this document?
The document is a statement of information from the California Secretary of State.
Okay, and why is this document relevant?
It identifies the successor trustee in this case as an employee of a company related to the taxpayers.
Okay, and have you provided this document to opposing party?
Yes.
Yes, okay. Let me turn to appellant. Any objections to the admission of this evidence?
Yes, we do object to it. It's late. We've not had time to prepare for it.
Okay. Let me turn back to the Franchise Tax Board. Do you have good cause for this late submission?
The good cause, Judge Lee, is that it's extremely relevant to this case. This is a company owned and controlled by Mr. and Mrs. Pasveer, and presumably they are in control of these filings. They're aware of these filings. This is not a surprise piece of evidence. It's their own company's public record information, and there's no issue with authenticating it, as it is a government document taken directly from the Secretary of State's website. Thank you.
Thank you. Let me give us just one moment while I confer with the panel. Okay, the panel will allow this exhibit to go in because it is relevant and it's not voluminous. So that exhibit, did you say that was exhibit R?
Correct.
Right, okay. Okay, before we go on the record, anything else the parties would like to discuss? Franchise Tax Board?
I was just wanting to clarify whether or not there was a consensus on if interest was still at issue in this case. Franchise Tax Board abated interest, or agreed to abate interest for April 7th, 2017 through July 25th, 2019. And it wasn't clear at the pre-hearing conference if the taxpayer agrees to that.
I see. Okay. Let me turn to appellants here.
I thought we did agree to it, but yes, we are in agreement on the abatement period.
Okay. I guess there. I think based on our pre-hearing conference. They're asking, are you making arguments regarding any other periods for abatement of interest?
We are not.
You're not. Okay. Thank you. Let me now check with appellants. Any questions or comments before we go on the record?
No, Judge Lee, we are prepared to proceed.
Thank you. And let me check with our stenographer to make sure we're ready. I see a nod, so we're ready. Okay, let's go on the record. We are opening the record in the consolidated appeals of PaMaCo, Inc. and Pasveer. This matter is being held before the Office of Tax Appeals. OTA case numbers are 2103, 7380, and 2103-7405. Today's date is Wednesday, February 12, 2025. The time is 9:50 a.m. This hearing is being held in person in Cerritos, California. Today's hearing is being heard by a panel of 3 administrative law judges. My name is Mike Lee, and I will be the lead judge. Judge Josh Lambert and Judge Teresa Stanley are the other members of this tax appeals panel. All 3 judges will meet after the hearing and produce a written opinion as equal participants. Although the lead judge will conduct the hearing, any judge on this panel may ask questions or otherwise participate to ensure we have everything needed to decide this appeal. Now for the parties' introductions. For the record, will the parties please state their names and who they represent, starting with respondent.
Matthew Miller for Respondent Franchise Tax Board.
Casey Llewellyn for Respondent Franchise Tax Board.
Thank you. And turning to appellants.
Mark Lobb on behalf of the appellates and taxpayers.
Elaine Soreo on behalf of the appellants and taxpayers.
Marina Pasveer, the appellant.
And Judge Lee, also in court is our expert, Anthony Goshen, is sitting behind me.
Thank you. Let's move on to my minutes and orders. As discussed with the parties at a pre-hearing conference on January 27, 2025, and noted in my minutes and orders, there are 3 issues in this appeal. The first is whether appellants' transactions lacked economic substance. The second is whether the non-economic substance transaction penalty under RNTC Section 19774 was properly imposed. The third is whether the interest-based penalty under RNTC Section 19777 was properly imposed. In this appeal, as mentioned earlier, respondent has agreed to abate interest for the period April 7, 2017 through July 25, 2019. Appellant will not be making any arguments regarding additional abatement of interest for additional periods. Appellant's exhibits 1 through 33 were entered into the record in my minutes and orders. After the pre-hearing conference, appellant submitted exhibits 34 through 51. Respondent did not object to those exhibits by the deadline notated in my minutes and orders, so exhibits 34 through 51 are entered into the record. Turning to respondent's exhibits A through O were entered into the record in my minutes and orders. After the pre-hearing conference and at this hearing, respondent submitted exhibits P and Q and also R. Appellants did not object to exhibits P and Q, so those are admitted into the record, and exhibit R is also admitted into the record. At this hearing, the following individual will testify: M. Pasveer and Anthony Goshen. This hearing will begin with appellant's presentation and witness testimony for up to 1 hour and 30 minutes total. And also, appellant stated that they will not be calling Steve Tweedlie as a witness. Let me check the parties for comments. Respondent, any questions or comments before we begin with appellant's presentation?
No.
Okay. And turning to appellants, any questions or comments before we swear in the witnesses?
The only comment that I have is that with respect to the newly admitted exhibit, at some point I would like to take a break so I can look at it and confer with my client concerning that exhibit, because we haven't had the chance to do that yet.
I see. So you would like to take a break so you can look at it, and then is that something you want to talk about during your presentation?
I don't know, because again, it was given to us right before we came into the room, so I don't know much about the document, and I do not know what point it is that they're going to try to make relative to that document.
Okay. How about this? I'll take a break after respondent presents. That way, it gives you opportunity to hear what they have to say about the exhibits, and that way you have time to look at the document and see what points you would like to make in regards to it.
Okay, very good. Thank you.
Thank you.
Judge Lee, may I suggest something?
Yes.
We will likely use that exhibit in our cross-examination of Mr. Pasveer, so it might be best if they are able to consult before he testifies.
Okay. In that case, yeah. In that case, we'll take a break. How long do you need? Would 5 minutes be enough?
5 minutes is fine.
Okay. So we'll go ahead and go off the record. We're going to take a recess for 5 minutes, and we will come back. Right now the time is 9:55. We will come back at 10 a.m. Please mute your microphones. Thank you. Okay, let's go back on the record. Appellants, have you had time to review the exhibit?
Yes, Judge Lee, we have.
Are you ready to proceed?
Yes, we are.
Okay. In that case, Mr. Pasveer and Mr. Golson, would you both raise your right hand? Do you? Okay. Let's start off with Mr. Pasveer. Would you raise your right hand? Do you swear or affirm to tell the truth, the whole truth, and nothing but the truth?
I do.
Thank you. And turning to Mr. Golson, do you swear or affirm to tell the truth, the whole truth, and nothing but the truth?
I do.
Thank you. Okay, appellants, you have the floor. You may begin when ready.
Okay, thank you very much. Thank you, panel. I have a few comments to start, and then we'll call our witnesses. I will not rehash all of the details that have been briefed. I take it that you have all of that and have access to it, so I think it's a waste of time to hash through that. There are a few points that I would like to make to sort of accentuate issues that we'll be discussing today through the testimony. And one of those issues is that 10 years later, we're in this room and we're talking about an installment sale to an irrevocable trust. And that's what has always been at issue here. The backdrop to all of that is the reporting. And with respect to the reporting, the question being, was this transaction entered into for the sole purposes of avoiding paying tax? I'm going to go through the transaction a little bit piece by piece right now. I won't take a long time doing it, but I'll show you how that argument falls apart immediately. And the fact is, at the end of the day, not only was tax not avoided, but more tax will be paid at the end of the day. So if anything, it was counter to any concept of trying to avoid tax. So every day in the world of estate planning, attorneys fund assets into, when I started practicing law, it was limited partnerships. Now it's limited liability companies. And then there's a process of doing an installment sale of that asset to a trust, an irrevocable trust, and it's done for the purposes of lessening the estate tax burden when the grantor dies. This happens every single day in this country, and it's been happening for a long, long time. There's a whole industry of estate planning where there are installment sales to trusts. When you make an installment sale to a trust, you create what's called an estate freeze. And what you're doing is you're getting assets out of your estate for the purposes of freezing them for estate tax purposes. When the grantor dies and the 706 return is filed, that 706 return is going to show whatever's left on the installment note in the estate, and out of the estate is whatever asset was sold into that irrevocable trust. Again, this has been happening for a very long time. It took the IRS a very short period of time to look at what happened here and give a no change, and that's what happened. And then years and years and years passed, and we're sitting in this room now talking about what took the IRS a very short period of time to resolve. Now, we'll talk about why that is and why the IRS had such a short period of time to make a decision that there would be a no change. But let's go into what happened here. What happened was a very valuable asset is now in an irrevocable trust. It's in a trust that has a 37% compressed tax bracket after the first 14, I think it's now almost 15,000 in income. So there is no tax efficiency there whatsoever with that compressed tax bracket. On the installment sale side of things, you have an interest payment that gets paid to the taxpayer from the trust for the sale of the asset. That tax obligation did not exist before that transaction occurred. So you have created tax. When that installment note is paid, tax is picked up. And there are two taxes that are picked up. From the state level, this is a very poignant issue that must be considered, and that is there's no difference here at the state level between capital gains and ordinary income. So when there's an expense deduction taken, in this case by the entity PaMaCo, in making a royalty payment to, in this case, MPIP, which was the LLC that was sold, there's an expense deduction, and the respondent points out that is tax advantageous to that entity. Who owns PaMaCo? It's the taxpayer, the individuals, and Mr. Pasveer sitting here. But ultimately, when there's a payment on the note, that tax is picked up, and here it was paid. So the tax didn't go away. It just got paid in a different place. What we do know is there's a very valuable asset now in an irrevocable trust. And that from an estate planning standpoint, that's the goal of this type of planning. Now, I'm not saying that everyone in the tax world is in love with installment sales to irrevocable trusts. In this last administration, through the Build Back Better Act, there was a proposal to eliminate the ability of taxpayers to do this type of transaction. That law was never put in place. It didn't happen. In April of last year, I believe it was Senator Elizabeth Warren again proposed that the tax policy going into this year would include an elimination of estate freezes for estate tax purposes. Again, that policy proposal is off the table at this point. So we're still in a world of being able to do installment sales to these trusts. Now let's unpack what we're dealing with here. We're dealing with intangible assets. So obviously, normally we think in terms of, okay, dad funds a piece of real estate into a limited liability company, sells minority interest, takes a discount, and has that into an irrevocable trust to get the estate freeze. We think of real property, but here there were intangible assets. There were two intangible assets. One of them was a trade secret, and the other one was a customer list. The taxpayer will testify today that he never signed a non-compete with any of these companies, meaning that these assets, for all intents and purposes, were the assets of the taxpayer. We've cited law on this issue going back to Martin Ice Cream, which was the original tax court case that sort of spawned this whole idea that intangibles can be held by the owners or the employees of a company if there's no non-compete. There was no non-compete here. There were two third-party valuations performed. There was one in the initial stages of the planning and the funding of the asset into MPIP for the installment sale. There was another one that we had performed by Mr. Goshen, who will testify today, before this hearing for a few reasons. One is we couldn't find the old valuator. The other reason is that we wanted to have a fresh set of eyes on the valuation process here. So the number that was used, the original number of just over $10 million, was not made up out of thin air. A third-party valuation expert was paid and performed that valuation. We then had another one performed. And what you're going to hear from Mr. Goshen is that Mark Pasveer's group of companies function at a higher level than his competitors. That's the secret sauce. That's the trade secret. That's what pushes his company to be more competitive in the marketplace and to make a premium profit in his industry. And that is in part what was sold. The other part of what was sold was a customer list. The customer list and the trade secret to this day remain. They are used. They're in MPIP, and they provide a very valuable asset for the group of companies that are paying licensing fees to PaMaCo, which is ultimately paid to MPIP. So what does that mean at the end of the day from a tax standpoint? What that means is that to the extent that Mark Pasveer decides at some point that he would like to retire and sell his company, no buyer on this earth is going to buy his company without buying that intangible asset or those intangible assets held by MPIP. It's not going to happen. And they're going to look at the valuation reports and their due diligence. They're going to have their own valuations performed, and there's going to be an allocation. And just like in Martin Ice Cream, there was an allocation, and that allocation was done at the time of sale. They didn't even have the asset isolated. They did their own allocation at the time of sale. This asset was isolated in 2010, so we know what it is, and we know where it is, and we know it has a value. We also know that when the buyer comes in, the buyer wants Mark Pasveer. The buyer is going to say, I'm going to buy the assets out of MPIP, and I'm going to want to non-compete with Mark Pasveer, because if they don't have those two things, he can go down the street, set up a competing company, and undercut everything that buyer wanted to do. This happens every day all over the country. It's a very standard thing. I've seen it happen over and over in my 35 years as an attorney where you have a roll-up. In this situation, you would be rolling up the intangible assets out of MPIP into the bigger transaction, and a check is written. Now, when that check is written, that check is going to be an allocation towards that trust. That trust is an irrevocable trust, and again, after the first 14,000, I forget, it gets indexed up, maybe it's just under $15,000 of income, it hits a 37% compressed tax bracket for federal taxes. Is that a win for the taxpayer? I don't think it's a win. All the tax is picked up, and it's on the total value of that asset. He's isolated a very valuable asset in that trust. The note, and by the way, the taxpayer will testify today, he's continued paying on the note and picking up all the tax to this day from the date of audit, and he's not been taking the expense deductions. So someone who's trying to avoid tax does not do that. They're picking up tax at two different levels because of this audit. They're not getting any benefit from the structure whatsoever, and even more so, they're going to get hit a third time when they sell because that note's getting paid down. The note will be zero. The amortization will not pick up any income. It's not going to offset anything, and they'll get a big check for 10 or 15 or 20 million to the extent that that asset's risen in value into that trust. It's in an estate plan. It was settled for his two daughters, and that will be something that they have that's a part of their family legacy for those two daughters in the trust, not out of the trust, not in the estate. So it's a phenomenal estate planning tool. Again, it's been used all over this country continuously. Now, I read the respondent's brief, and I have a couple of comments on that, and then we'll get started with the testimony. One item is this. There was a gentleman named Larry Stevens, and Larry held himself out to be a CPA, and he was ultimately hired by Mr. Pasveer to do tax returns for him. Ultimately, what we found out, and also Larry Stevens was used as the independent trustee initially. The taxpayer is going to testify that ultimately he found out that Mr. Stevens was not, in fact, a CPA. He had been making misrepresentations to people, and he was filing the returns. But ultimately, Mr. Stevens went to jail for some investment scheme that he was involved with. That investment scheme had nothing to do with the planning that took place here. It had nothing to do with his conduct as the fiduciary. Conceivably, and thank goodness that this came to light to Mr. Pasveer so he could get rid of Larry Stevens, because obviously he was not a trustworthy individual. You would not want him as a fiduciary. But it has nothing to do with why we're here today. What happened with that gentleman is a red herring. The other thing I'd like to point out is that aside from not following the guidance for the FTB and adapting what the IRS did relative to the IRS audit, the Franchise Tax Board, after 10 years, has not spent time with Mr. Pasveer to understand his industry or what he does or what that secret sauce is, such that he has an intangible asset that's very valuable and something that he can do estate planning with. The IRS went to Mr. Pasveer's office, met with him on 2 occasions, spoke with him on the phone. We allowed all of it to happen because we understood that there was nothing to see here. And shortly after they met with him, they did the no change, and it was over with. 10 years in, they've not met with him. They've not asked these questions. And I think that after they hear his testimony today, they'll agree that this is legitimate. It does not eliminate tax, and it is a phenomenal estate plan. And it's also asset protection, because if something happens to one of the group of companies by way of a liability, those intangibles are protected in an irrevocable trust. So on that, I will submit my opening, and then we can call witnesses. Any questions before we start?
Let me turn to the panel. Judge Lambert, any questions at this time?
I don't have any questions at this time.
Okay. And Judge Stanley, any questions?
No questions yet.
Okay. No questions from me either. So please proceed with your witness testimonies.
Okay. So the appellate will call Mark Pasveer. Mr. Pasveer, can you please provide counsel and the panel with a brief overview of your personal background and your business background?
Sure. Obviously, my name is, I'm Mark Pasveer. You will probably have seen in the original documents that on the tax returns, etc., that it is Marinus Pasveer. I am originally born in the Netherlands. We have a custom, it's customary there that when your parents send out your announcement cards, we have a son, Marinus, and we name him Mark. So that's why you will continue to see those two names crisscross everywhere on all these documents. Anyway, so to that story, I'm originally from Europe, attended college there, was able to find employ with a business in the Netherlands, where I'm from, that at that time was performing significant landmark type projects all over the world. And at a very early age, I was able to grow through the ranks and had opportunities to be stationed through that company at various parts of the world. Started off within Europe, in Germany and London, Germany and England. Later on, our travels took me to Asia, Kuala Lumpur, Singapore, a brief stop in Dubai for a number of years. And then in 2020, we landed in the United States in 2000, we arrived in the United States. This is still all for that same company. As I was working for that company, I got very, very detailed exposure to how to set up entities, how to grow companies, how to protect yourself from the imminent risks that exist in construction. We always say the question is not if, but only when you're going to get sued one day for things that are that may be within, but most of the time are outside of your control. So it was a very important part for us to, as I was working for that company, to follow that strategy. Back in 2005, I came at a time and age that I honestly was ready for a next chapter, and I started establishing my own company. Early from the onset, as I had learned in my experience, the first company that I established was PaMaCo. PaMaCo stands for Pasveer Management Company. That was the first company I established, and I did that for the purpose of making that strictly a management company. I followed the steps that I had learned and that had been proven successful by setting up operating entities that were working in different segments of the market. International consulting services was one of those. Exterior cladding systems was one of those. And there have been a number of entities that we have established that are each operating in their own unique segment, yet with a very unique skill set, but without really any tangible assets in that entity. All the tangible assets were held in PaMaCo. And again, the reason for that at that time, as we started off this process, was to protect our assets.
Why don't we? So we started out with personal and education, and thank you for that. You are married, correct?
I am married. Sorry, I got carried away there.
That's okay. You've been waiting for 10 years. I understand.
No. So yes, I am married. My wife, originally from the Netherlands, she has. I'm lucky enough that she has joined me on all of those travels. Our daughters were born in, the oldest one was born in the Netherlands, the youngest was born in Malaysia. They are now 28 and 26. They have their own lives as educators. And that is...
Okay, and you have a grandchild?
Last year we became grandparents, yes, a different dimension of continuing on in life, I can say. Yep.
Okay. And how long have you been in the construction industry?
I have been in the construction industry since literally I got out of college. My earlier explanation of how I joined that large company that worked internationally, that happened right out of college.
And what was that job?
I started off as a project manager. The company was called PaMaCo. They are still around. They are one of the largest companies in their field in the world. I started off as project manager and worked myself up at a rather young age to an executive management level.
Okay, and then moving forward, with respect to PaMaCo, you mentioned that it was one of the first companies that you set up, and you set it up as a management company. When you set that company up, were you working with professionals in the United States?
Yes, I mean, in professionals, is the question related to the professionals in the field of the company, or?
Well, no, I'm going more towards attorneys, financial planners, CPAs. Did you have professionals that were guiding you at the time that you were setting up, for instance, PaMaCo?
No, not at first. Not at first. I had enough business knowledge to set up the initial structure. I would say more detailed financial planning was something that came at a later point, but it was not our initial take. We were honestly, at that time, 2005, our main focus was establish companies and start generating revenue and income.
So you set up PaMaCo and you set it up as a management company, and that was before you were meeting with other professionals such as financial planners, correct?
Absolutely.
Okay. At some point, did you start bringing planners such as a financial planner into your life for consulting purposes?
Yes, it has been an evolving process. Obviously, the day you establish a company, you're not your revenues start like with every other company. You know, first year is, and every year is hard work, but the intent is to start making money, and only until the point that you start generating serious revenue, that's when I became aware. Okay. This is taking on a different dimension, all in the good sense. However, this is going to require involvement from some professionals to start looking at proper life insurance, health insurance, other type of insurances. We weren't really, so we had a financial advisor, Mr. Strom, that helped us establish a will and testament. Those were the items that we started to think of as we were developing our group of companies.
Okay. And at some point, did Mr. Strom introduce you to other professionals?
Yes, Mr. Strom, as the group of companies and the extent of work we were performing was increasing, we were introduced to Larry Stevens as a CPA. This was 2008, 2009. And as we, as the companies evolved and business activity increased, we had asked Mr. Strom to see how we could, start working on a next level financial planning for both the companies and me as an individual and our family. And that is how in, I would say, 2009, 2010, we were introduced to the company, to actually the company that you work for, Lop and Cliff at the time, Lop and Pluie now. But that is how the involvement of professionals came to exist.
Okay, so you met Mr. Strom for financial planning, and then he introduced you to Lop and Cliff and to Mr. Stevens. Is that correct?
Correct. The exact sequence, I don't know, but it was all within a relative short time frame.
Okay, and who did you work with at Lop and Cliff?
At Lop and Cliff, I worked with Erica Peterson and Sam Lockhart. Those were my two main points of contact.
Did Mr. Strom tell you why he was introducing you to Larry Stevens and Lovencliffe?
In his opinion, they were people that were reputable in the industry, and that had a record of satisfied clients, which was always my gauge. Is there other clients that are happy with their performance, and I got acknowledgement on that.
Did you ever tell? Let's start with Larry Stevens. Did you hire Mr. Stevens so that you could avoid paying taxes?
No, I hired Mr. Stevens as a CPA. Nothing more and nothing less. I mean, we had our own accountant in our company, but we had, as the company was growing, there was always the necessity to submit accountant's reports, CPA letters, and so that is why that's why we hired Mr. Stevens to help us with our year-end reporting and to be our CPA on record in the event that, for instance, if we bid on a large project, we were always required to submit financials. And of course, it looks better if that comes from a CPA than from a person that just does tax, that is just a tax, that is just preparing tax returns. So that was our reason for involving Mr. Stevens in our companies.
And then at one point you hired Erica Peterson, and what was the other attorney's name?
Sam Lockhart.
And you hired them to represent you, is that correct?
Yes.
Did you ever tell them that you were hiring them so that you could avoid paying your taxes?
No. The primary, as I said, this has been an evolving.
If I can interject, to the extent that you're mentioning names that were not included in your list of names, if you can spell those names.
Erica, Erika, Peterson, Peterson, and Sam Lockhart, Lockhart.
Okay, thank you.
Okay.
I believe their names are in all of the
In the documentation.
in the documents
Right.
as being the authors of some of the documents. Sorry, I lost my train of thought.
We're going back to the reason why you're hiring these professionals, and I just want to make it clear that you were hiring them for what purpose? To consult for what purpose?
Fair enough, yes. I'm back on the rails. Our primary purpose, as I said, the company was growing. We were taking on projects. Some of those projects were rather large, and we felt that at that point in time, we needed to improve our asset protection. We wanted to start really our estate planning, which we really hadn't done until that time. And in one of my eye-opening meetings with the team, with Erica and Sam, was that don't wait with estate planning until it's too late. In other words, don't wait with estate planning until you're 50, but start it when you're 35 or 40 or earlier if you can. And that was the primary purpose: estate planning, asset protection, and succession planning for our growing group of companies.
And again, at the time that you're meeting these professionals, PaMaCo already existed, correct?
PaMaCo already existed, yes.
And did you have other companies that you had created before you met with these professionals?
Yes, several operating companies. We had also started to divert into real estate development. Again, one of our early lessons was to not mix and mingle different real estate. So we had a lot of different LLC that were each single asset LLCs that were holding real estate. Whether that was ground-up development or whether that was a single-family residence or multifamily residence. So we had all of these LLCs. And we also had some operating companies that were established just to execute one project. So these companies were established. they performed the project, and they are winding down several years later. So there was definitely a group of companies in existence at the time that we started to meet with Erica and Sam from Lop and Cliff. Otherwise, honestly, we would have probably not gotten to that point.
Okay. At some point, did you create a company called MPIP LLC?
Yes, we had that company was the result of my discussions with the professionals on establishing a planning and a structure that would help us address those three items that we mentioned earlier, and asset protection, succession planning, and estate management. And MPIP was an integral part of that, as it was going to capture the intellectual property. I think you used the term secret sauce, which I think is a little bit disrespectful for my intellectual property. But it is to say that with my experience that I have gained over the years working in all facets of construction at different continents, that I had a certain amount of knowledge that had proven to be very useful and successful. And in the discussions that we had with the professionals, it was opted to capture that in MPIP. MPIP stands for Mark Pasveer, Marinus Pasveer, Intellectual Property.
Okay, before I go any further, I want to ask you, at any point in time ever, have you ever signed a non-compete agreement between yourself and any of your companies?
No, I have not.
Let's go back to MPIP. Did anyone ever tell you that by creating this entity and capitalizing your intellectual property into MPIP, that you could avoid paying taxes?
No. I was not told that. We did discuss the tax structure on how it would, what the ultimate plan was with the structure, but it was clarified and confirmed that the payment of taxes would occur through various entities, still land on my personal return, which it has been and continues to do through this day, but certainly not. There has not been a tax avoidance. There would be estate tax benefits at some point down the road. That was clearly discussed, and frankly, estate planning was an essential part of this structure.
And ultimately, you caused a trust to be created. Is that correct?
That is correct.
And we refer to that trust, if I use the terminology, Children's Trust. Does that ring a bell?
Yes, given that my two daughters are the beneficiary of that trust. And again, as part of the input and discussions with the professionals, this was determined to be a very effective and safe way of preserving and maintaining wealth for a generation beyond me, which, as I got older, gets a new dimension. You know, even if you're a grandparent now, you think of your children's children, and so that was the intent and purpose of the trust.
Ultimately, you or someone made a decision to have Larry Stevens, the CPA, as the independent trustee. Is that correct?
Yes. We have, my wife and I have moved here. We are the only ones of our family that that are residing in the United States. And at that time, with the Children's Trust, we were looking for an independent, qualified person that could handle that responsibility. Little did I know of Mr. Stevens' dark side, if you can call it that way, that was exposed 5 years later. But that was our reason for assigning Mr. Stevens as the trustee. And again, that's what he was.
Did Mr. Stevens ever tell you he was a CPA?
Yes, it's actually, I still remember it was on his email signature.
And you believed him?
I had no reason not to. He was professional. The tax returns, for as far as I could see, were done orderly, timely. I went to visit him at his office just to make sure, with similar as I went to the Lopen Cliff or Lopen Pluie office. I want to always have a feel for the people that I'm dealing with. And I found a real office, real people, no reason to believe any different.
Now, at some point you found out that something was awry with Mr. Stevens, is that correct?
That is correct. We were notified by Citibank, or actually the way it went, Citibank, where the trust account was established at the time, had sent notices to Larry Stevens that literally, I still remember, it was a one-paragraph letter that says, your account will be closed and a check will be mailed. And that caught us really by surprise. Luckily, Mr. Stevens forwarded that letter to us. And so we had still no idea what was going on. So we reached out to Citibank and say, what is happening here? We have 6, 7, 8 companies with you guys. How can you just close an account on us? And we had a good relation with the manager from Citibank, and they told us, look, we can't give you much detail. The only thing that we can tell you is that it is related to the signee of the Children's Trust, which could only be one person, Larry Stevens. So at that time, our suspicion started to raise. We, what we do in modern day, we start Googling, and we start to learn, and we see some rumors on the internet of investment schemes that people are not happy with Larry Stevens. And after several weeks or months, we thought that it was prudent to not take any risks. And we had asked Mr. Stevens to resign because we started to get a bad taste of everything that was going around.
And did he resign?
He did.
Again, you're not related to Mr. Stevens?
I'm not.
And was he ever an employee of yours?
No.
And you ultimately hired Mr. Feng to be the independent trustee, is that correct?
Yes, that is correct.
And at one point in time, did you sell a company to Mr. Feng called Exterior Cladding Systems, Inc.?
I did, on or about 2020. I don't know the exact year.
And counsel this morning provided us with a filing from the Secretary of State, and it has the identity of Exterior Cladding at one of the documents has them at your office address. Is that correct?
Correct. 431 Leroy Drive is a building that we at that time owned, and the company that was sold was essentially paying rent to us, was using our building.
And another document was provided by counsel, and it shows a different address. Is that the address that the company now is operating out of, to your knowledge?
Correct.
Okay. And are you related to Mr. Feng?
No, I'm not.
And is he an employee of yours?
No.
Okay, I know I'm jumping around a little bit, but let's go back to MPIP. Do you know what assets are held in MPIP?
Yes, MPIP, the assets in MPIP are, consist of two main buckets. One is a proprietary, very technical knowledge of systems, procedures, and management of complex projects. The second bucket is the our client list, my client list that I have been developing and growing over the years of my career, and that client list includes a variety of contractors, architects, developers, manufacturers at various continents that we have continued doing business with through this day.
And the trade secret that you referred to in the customer list, did you cause that to be capitalized in MPIP in 2010?
Correct. Yes, I did.
And is that customer list and the trade secret, are those items still in MPIP to your knowledge?
Yes.
So the customer list is still intact?
Absolutely.
And the trade secret is still being used?
Correct.
Okay. Now, early on in the planning process, did you hire a valuator to place a value on MPIP or the assets inside of MPIP?
Yes, that was part of the strategic planning that we involved the professionals with, and that included a valuator, correct.
Did you ever speak to the valuator?
Yes, I did. We spoke to the valuator. We provided a detailed list of trade secrets as well as financial documents for years prior to the valuation.
What types of documents did you provide the valuator?
They were profit and loss and balance sheet statements of the companies operating at that time. They were also very technical descriptions of certain processes and procedures. For instance, we had a very detailed quality control procedure, very specific to our trade and industry, that helped us to be very successful. Another example was, and the backup documents are hundreds of pages that I had developed over the many years. Another aspect of that of those trade secrets were our ability to combine products that are being utilized in the industry in different continents. If I can spend 1 minute on that, the European building products are considered superior in the world's construction industry. There is a greater level of accuracy, detail, quality, longevity, whereas on the flip side, some of the building products that come from that are manufactured in Asia tend to have less of a good reputation and do show some occasional quality concerns. We had developed a system whereby we could utilize the European products with small adaptations that we had discussed with those European manufacturers so that their product could become very useful on the U.S. market and be sold as a superior product for a superior price. Likewise, we took the same approach from Asia. And sorry, a quick backtrack on those products that came from Europe. We have been involved in many large-scale projects. One example is the Disney Concert Hall in downtown LA. A very, very unique project where we applied some of those techniques. I was going back to the flip side, if you want to call that, on Asia, where there is quality concern. So we ended up making adjustments to the systems and processes so that we could take the advantage of using those products and applying them into the U.S. market. You cannot just take a product from another country and use it here. There is a process that you need to go through to make that system adaptable. That is one example that we had detailed processes and procedures outlined in our intellectual property statement.
Judge Lee, we have reached a point in the testimony concerning the trade secret that we can go on a little bit, but we're somewhat not comfortable with this being going out to the public with all of the items that he has as trade secret in MPIP. I'm wondering if you have a process for continuing testimony without it going to the public, or if at some point you want us to just truncate the testimony. I'm unsure of how this is handled in other matters.
So typically, the parties should have let us know ahead of time if they wanted a closed hearing for a portion of the testimony. Give me a moment to confer.
Thank you.
To see if that's possible.
Thank you.
Okay, let's go ahead and take a 5-minute break, recess. We'll go off the record. We'll come back at 10:54. Please mute your microphone. Thank you.
Thank you.
Okay, let's go. No, okay, let's not. Let me know when you're ready. Okay. Okay, let's go back on the record. Per OTA's regulations, a request for a closed hearing was supposed to be submitted 15 days before the hearing. Given that we will not be having a closed hearing today in regards to the trade secrets, you are free to give an abbreviated version of your testimony. After the hearing, we will allow appellants to submit a post-hearing briefing and declaration that includes the testimony that appellants want to say regards to the trade secrets. We will also ask appellant to explain why that testimony should be sealed per OTA's regulations. If OTA grants appellant's request to seal the record, then we'll keep that in the record. But if OTA takes a look at the declaration and appellant's request and determines that it does not meet the criteria to be sealed, then we will remove it from the record. Respondent will have the opportunity to respond to appellant's declaration and the opportunity to ask questions in regards to the declaration. Appellants, any questions or comments?
I want to thank you, Judge Lee, and the panel for allowing us to do that. It's very much appreciated, and we have discussed truncating the testimony today just to give you a flavor for the trade secret that exists. He's already started into that, so we thank you.
Okay. Turning to Franchise Tax Board, any questions or comments?
Yes, just one question, Judge Lee.
Yes.
You mentioned first you would give an opportunity for additional briefing and the declaration, and then second, you said you can submit the declaration later. Is it simply going to be a declaration they're submitting, you're allowing, or is there going to be additional briefing?
It would be the declaration plus briefing on why it should be sealed.
Oh, the briefing is only to the issue of why it should be sealed then?
Yes.
Thank you.
Yeah. Thank you. And with that, I believe that resolved that issue. Please proceed and with the abbreviated testimony regarding the trade secrets.
Thank you very much. So, Mr. Pasveer, before we took a break, you were talking about intellectual property concerning certain processes and what you experienced in Europe and in Asia. Let's provide a little more testimony in that regard, and then we'll move on to some other issues.
Yeah, I mean, the product adjustment to make it suitable for specific segments in the U.S. market is what was covered under those two prior, call it umbrellas of materials from Europe, materials from Asia, several other items in an abbreviated version. In today's market, you may have heard the term modular construction. That was something we already had implemented in 2007, 2008, 2009, essentially prefabricating components to a extreme large intent and doing that under very strict conditions, quality procedures, having certification of those products before it reaches a job site. So we had a process in place for that well before it became common knowledge. And so while that in and by itself is no longer a trade secret now, but it was a trade secret then. Other aspects of our intellectual property was how we had specific management bonus structures set up to incentivize our workforce to help us achieve the best outcome for the company. And those were split up in different scenarios that we had learned over the years had worked very well and proven to be valuable. Other aspects of the intellectual property consisted of our material management systems. Being in construction, there is a lot of moving parts on any given time, on any given project. We had written proprietary software that we had developed that would allow us to track location of materials essential for sequential installation on a project site. Again, that was something that others have developed at a later time, but we were definitely well advanced of our time at that time.
Okay. I know you have many other items, but we will handle that post.
Sure.
Okay. Thank you. Now, we were talking about the evaluator and the information that you provided the evaluator. Do you recall the name of the evaluator?
I do not recall the name. I recall the company. It was Avalon Consulting, if I'm not mistaken. I don't know by heart the name of the person.
Okay, Avalon Advisors. Is that
Avalon
something familiar?
Advisors, yes.
And so you provided information. You had conversations with evaluators. Is that correct?
Correct.
Did you know this evaluator before the evaluation was performed?
I had no prior history of ever being in contact with them, no.
So you had never worked with Avalon Advisors or the evaluator before this evaluation on MPIP was performed?
Correct.
Okay. Ultimately, evaluation was performed. Do you recall reviewing the evaluation report?
Yes, I do recall reviewing the evaluation report, and again, had no relied on the professional in that field as far as the outcome of that report is concerned.
You didn't tell the evaluator what number they should come up with in the evaluation, did you?
No, we did not.
Do you know if anyone ever did that?
No. It is, from what I understand in talking to the evaluator, it is a very complex process. I'm not privy to how those numbers are derived.
Okay. Now, with respect to the IRS audit, did you ever meet with the auditor?
Yes, we met with the auditor at our office, and we were able to, in summary, walk him through the steps following on how the companies were established, which company was doing what, why we had these different entities that were operating in these different fields, and for what purpose, and that included MPIP. I do remember, as part of the meetings and subsequent information requests and meetings thereafter, there were a substantial amount of documents requested and provided that showed the entire history from almost the same audit, essentially the same audit period here, even though the IRS audit period was I think only 1 or 2 years, but it covered, the documents provided covered the exact same transaction that are under audit here today, and we were able to demonstrate that those transactions ended up showing up on our personal tax returns, and me and my wife as individuals paying tax over that.
How many times did you meet with the IRS auditor?
I recall 2 times at our office and 1 or 2 phone calls.
How long did the meetings last?
Hour and a half.
Okay. And ultimately you received no change from the IRS, is that correct?
No change on PaMaCo, no change on MPIP, no change on personal, correct.
Okay. Now, at one point you hired Anthony Goshen to provide evaluation, is that correct?
That is correct.
And did you tell Anthony, did you tell him what number you wanted him to come up with by way of the valuation?
No, we did not. We wanted this to be an individual. As again, in my layman's term, if I go to the doctor, I want a second opinion. In my view, that was this. Somebody reconfirm if what we assumed was correct.
Did you ever speak with Mr. Goshen?
Yes, we had several conversations. Mr. Goshen asking us clarification on the documents that were the same documents as that were the basis of evaluation of the one from Avalon Advisors.
Did you provide Mr. Goshen with the same information that was provided to Avalon Advisors?
Yes, it was the exact same package.
And when you spoke with him, you provided the same information to him that you provided Avalon. Is that correct?
Correct.
Okay. Now, since the FTB audit began, have you continued to pay principal and interest on the promissory note?
Yes, we have. That is, it is an obligation of that the Children's Trust has to make payments, principal and interest payments, and we have been continuing those payments ever since the implementation of the structure through last year, and we are set to report the same payments this year. So, in short, principal and interest payments have been made beyond the audit period without taking any expense.
And how much has been paid in principal since the audit began?
Approximately $1.5 million.
And how much in interest?
Approximately $1 million.
And did you report all of that income on your personal tax returns?
Yes, we have.
When you say we make the payment,
Sorry,
who's making the payment?
Well, it's a joint tax return, my wife and I. So when I say we, I mean I make the payments, although in our household, my wife's write the checks. So,
Okay, you're talking about paying tax. What I'm asking you is the trust, who from the trust is making the payments on the promissory note to you and your wife personally? Is that the trustee?
The trustee, yes.
Okay, and that's Mr. Fang?
That is correct.
Have you ever taken, other than payments of principal and interest, have you taken personally any assets out of the Children's Trust?
No.
Okay. Okay, those are all the questions I have for the taxpayer.
Thank you. At this time, let me ask Franchise Tax Board if they have any questions for the taxpayer.
Yes, we do.
Please proceed.
Thank you. Thank you. Sorry for the delay in pulling up my document. Good morning, Mr. Pasveer. Thank you very much for being here. It's a little awkward to be asking you questions without looking at you, so you forgive the setup. But just have a few questions for you today.
Sure.
First, on June 29th, 2010, you executed an agreement that purported to assign your interest in certain intangible assets to MPIC LLC, correct?
Correct.
You both signed and countersigned that licensing agreement. First, you signed it as the assignor of the assets, and second, you countersigned it in your capacity as manager of MPIC LLC as the assignee of the assets, correct?
Correct.
Oh, I'm sorry, I misspoke. I said MPIC, it's MPIP, for the record. One day later, on June 30th, 2010, MPIP LLC entered into a licensing agreement with PaMaCo Incorporated, by which MPIP LLC leased the intangible assets that you had assigned to the LLC to PaMaCo. in exchange for royalty fees, correct?
Yeah, I'm not sure about all the technical terms, but in broad terms, I think I follow your understanding of the sequencing of the transaction, and so far I think that's correct.
If I may, Judge Lee, if he, maybe it would speed things along if he referred to exhibits for the taxpayer to review as he's going through these documents. It's been 15 years.
Okay.
I'm happy to refer to exhibits.
Thank you.
This is an Exhibit F. Page 2 indicates the date. And I think that page also indicates the general provisions of the contract. I can repeat the question if that's helpful as well.
Yeah, but so far, as I mentioned, I confirmed the sequencing of documents as you of documents being generated as you stated.
Thank you. The next question is, you both signed and countersigned that licensing agreement. First, you signed it in your capacity as manager of MPIP LLC, the licensor, and second, you countersigned it as the president of PaMaCo Incorporated, the licensee, correct?
Correct.
One day later, on July 1st, 2010, you and Mrs. Pasveer settled the Pasveer Children's Trust with an initial contribution of $1, correct?
I don't know the exact numbers, but yes, I do acknowledge the sequencing of events and the trust being executed.
Sure. And if it's helpful for you to review, this is Exhibit G. Page 1 of Exhibit G indicates the date. Page 4 indicates the contribution amount.
Yep. Confirmed.
Thank you. You and Mrs. Pasveer appointed as trustee of the Pasveer's Children's Trust, as you already stated in your testimony today, Lawrence Stevens, correct?
Correct.
Can I just stop
Yeah.
you for 1 second?
Please.
Our stenographer isn't necessarily picking up your voice.
Oh.
You need to put the microphone closer. Thank you.
Judge Stanley, were you referring to me or the witness? Okay, thank you. Next question, Mr. Pasveer. On that same day, July 1st, 2010, you and Mrs. Pasveer executed a sales agreement whereby you and Mrs. Pasveer sold 99% of your membership interest in MPIP LLC to the Pasveer Children's Trust in exchange for a promissory note in the amount of $10,700,000, correct?
Correct.
And for the record, that's Exhibit J I'm referring to. And on October 8th, 2010, 3 months and 7 days after you and Mrs. Pasveer sold your 99% membership interest in MPIP LLC to the Pasveer's Children's Trust for $10,700,000, you obtained a valuation of MPIP LLC from John Bates, correct? This is Exhibit K.
Again, I follow your dates. I see the date here on the report, although I do believe that this report in a draft format existed way before this date, but
And have you provided the Office of Tax Appeals a copy of any drafts of this report?
not to my knowledge, honestly. I'm not sure what documents have been provided, but the sequencing, the sequence of events was that first a valuation was derived. I understand what you're saying with the dates on the piece of paper, but perhaps we can go back to old records to see when the engagement was initiated. But my point is that I again confirm your dates, but to my knowledge, the valuation existed well before the sales transaction.
Okay, thank you. I'm moving on to my next question. In his opening statement today, your attorney stated that there are two intangible assets in the trust, a trade secret and a customer list. However, Mr. Bates's report identifies 12 separate intangible assets that were subject of his valuation, dated October 8th, 2010, correct? Again, this is Exhibit K.
Yeah, I understand. Let's put it this way. I think the statement of Mr. Loeb of two items in the IP, I call them two buckets. One, a project list, and one trade secrets, whereby the trade secret bucket is unpacked in several other items, and those are the items that are referred to in the valuation report.
Thank you. In Mr. Bates's report, he lists the principal sources of his information for his report was his interview with you, and also you supplied copies of internally prepared lists and descriptions of identifiable intangible assets, organizational structure, current financial information, and 24-month operational forecast. Correct? That's on page 4 of Exhibit K.
Yes, I don't remember the exact details, but in general terms, yes, that is correct.
And you've never provided the Office of Tax Appeals copies of the documents you provided to Mr. Bates that were the principal sources of information for his report, correct?
I honestly would not know. I'm not sure if I believe the issue was that not necessarily was the valuation the issue of the audit, but rather whether or not this was a legitimate transaction. So I believe that, I'm not sure if the question was ever asked to provide this information or if it was ever put in question.
Okay, thank you. And I think that's all of our questions. Thank you, Judge Lee.
Thank you. Let me turn to the panel. Judge Lambert, any questions for the witness at this time?
I have no questions, thanks.
And Judge Stanley, any questions at this time?
I would just like to get a little bit of a better idea. I know you're talking generally about the things that are in the that are included in the trade secret bucket, but do you, when you utilize those systems, do you still maintain them as proprietary systems so that you're managing a project and tracking the materials flow, for example, or are you leasing them or selling them to other companies to utilize them?
Well, that is, so initially the structure was established, as I said, for multiple purposes: asset planning, asset protection, etc. So initially we have utilized these intellectual properties within our own, only within our own entities. Planning of this nature is not something that is a long-term process. Establishing a structure and bearing the fruits of that structure is not something that happens overnight. There is, realistically, there is decades that it takes for that to realize the asset planning or the asset planning for that. Now, at one point in time, there we discussed the opportunity of selling those all or portion of those intellectual property. However, since the audit in 2015 occurred, everything has come to a full stop. And so during our initial years of further growing, developing the companies, again, we were not yet ready when I was in the prime, or am, I still consider myself in the prime, but I was in the prime of conducting business. I wasn't necessarily thinking of selling intellectual property or a portion thereof. It could potentially become a point of a thought process later on, but that, for obvious reason, has never materialized to date. I'm not sure if I 100% answer your question, but
No, I think you're saying, I think what you're saying, if I'm understanding you correctly, is that you do maintain these and use them within your own companies.
Correct.
That you don't provide any
This-
parts of the processes
No.
to other people to use themselves.
that is correct.
Okay.
This information is used within our own group only.
Thank you.
Thank you, Judge Stanley. Is that in all your questions for right now? Okay. Okay, appellants, you can continue on with your presentation.
Yes.
Your Honor, may I say something?
Yes.
I beg your pardon. I said I was done with my questions. I had one more question I failed to ask. Is it, with your permission, could I ask one more question of Mr. Pasveer?
You may proceed.
Thank you. Earlier in your testimony today, Mr. Pasveer, you mentioned you had an interest and a need to develop an estate plan. Other than the documents relating to the Pasveer Children's Trust, you've not provided the Office of Tax Appeals any other documents relating to any other aspects of your estate planning, correct?
That is correct. And again, my answer, the first answer to your question is no. To my knowledge, I don't think we have provided that. However, there is no secret in providing any additional other information, whether it is will, testaments, things of that nature that were that exist in advance of this intellectual property. And again, I don't think the information was ever requested because it was never part of the audit of the subject that was under audit.
Thank you so much for your testimony today. No more questions.
Thank you. Appellants, you may go ahead and proceed.
Thank you, Judge Lee. The appellate would like to call Anthony Goshen for testimony.
Thank you.
Take a back seat. Okay. Anthony, do you want to sit up here with us? Is that yours? No, you can give it to him. Sorry. Thank you. Good morning. Judge Lee, did we swear in this witness? I forget. He was out.
We did.
Okay. Mr. Goshen, please state and spell your name for the record.
Hello, good morning. My name is Anthony Gosson. That's G. Sorry. Anthony Gosson, G-H-O-S-N. Middle initial Elias, Anthony Elias Gosson.
And Mr. Goshen, what's your profession?
I run a practice called Dynamic Performance Metrics. It focuses on internal audit services for private and public companies and business valuation, for which we do both enterprise valuations and intangible asset valuations.
And can you give us a rundown of your education, please?
Sure, of course. My formal education starts at the University of Washington with an economics degree, bachelor's BA in economics. And upon graduating, I happened to work in the project build design world of the hospitality industry for almost 20 years. In that capacity, I advanced up through supervisory roles, executive roles in various companies. And at that time, I went back to school and earned an MBA from the Claremont Graduate University. And at the same time, several certificates, one from Oxford University and one from Wharton. And those were both global marketing, global logistics courses that were quite valuable to me. And since then, in 2009, I specifically kind of pivoted away from internal audit and focused much more on business valuation and joined the ACA, Association of ASA, Association Society of Auditors, for ongoing professional training, CPE. Once a year, I do several courses. There's a USPAP qualification, Unified Standards of Professional Practice of Appraisal, and that every 2 years is a refresher for the standards, the procedures, and some of the details that should be in a business valuation, and other corner case issues where hypothetical conditions can be used, other kinds of more exotic approaches to valuation when necessary. And that keeps me current and with the ability to sign reports and submit to any regulatory body or any professional law firm, CPA firm that is requiring that information.
What certifications do you hold?
The USPAP certification. I also hold not back in 2010, but I hold the certified patent evaluation certification and the USPAP certification. Those are the two actual certs that rotate and require CPE to maintain.
Mr. Goshen, what professional organizations do you belong to?
If I can, excuse me, if I can interject, I understand that appellant has already submitted Anthony Golston's credentials and education. The FTB was given an opportunity to object. If they objected to the credentials and education, they have not. Okay, in that case, please, I don't see a need to go into detail regarding his education and credentials since it's not an issue here.
Thank you.
Okay, thank you.
So you were hired to provide evaluation, is that correct, on behalf of MPIP?
Yes.
Did you actually provide such evaluation?
We did.
Okay, and it's been marked as Exhibit 33. I see that you have it in front of you. You don't need to look at it right now.
Okay.
Let's just go through your testimony.
Of course.
What information was provided to you such that you could provide evaluation of MPIP?
Well, in our engagement letter, as all of our engagement letters state, we require certain documents from the party, the subject client, which involves financials that cover the period in which we're talking about, and at least 2 to 3 years prior. And in some cases, when we're looking back, when we're retro, we can ask for periods beyond 2010, which we did in this case. We also conduct interviews with the client, the subject client, subject assets owners. And at that point, we're trying to get a feel for both quantitative and qualitative aspects of the entity, or in this case, intangible assets. How are they used? How are they identified? How are they protected? And there's a full page in going into that in this report that goes into that more.
Did you actually meet with Mr. Pasveer?
Several times over the phone, telephonic meetings, yes.
And approximately how much time did you spend in meeting with Mr. Pasveer before rendering your valuation report?
Oh, at least 5 hours.
Before you prepared your valuation report, did you review the report from Avalon Advisors, which had been done in 2010?
I knew that Avalon Advisors had issued a report, and at some time I was expecting to see it. But as a normal practice, I don't look at numbers by another valuation expert until I've come to my own conclusion. So, yes, I looked at it, but not prior to our conclusion.
Okay, so your report was independent of Avalon. Is that a correct statement?
Absolutely, yes. That is a very important part of the kind of work we do, is that it's independent and that we can demonstrate that.
Okay. If you go to page 14 of Exhibit 33, there is a listing of items. What are those items?
These are the high-level statements of the value of the assets themselves, the aspects of what we're calling in use, and I'll explain that more. But these go into what Mr. Pasveer was talking about earlier in his testimony, some of the details in the IP. I could go into some examples, but on page 14, there they are, and that ties to well, I'm sorry.
Yeah, you don't need to go through the detail. It's listed there. I just want to confirm that page 14 was relevant to your valuation. And when you were going to say it ties to, did it ultimately tie to the valuation that was rendered?
Yes, ultimately, that is what that's tying to. And
In
that
what
gives
way?
us the assurance that it ties out. If we find variances or large gaps, then we're coming back to the client to ask questions.
Okay. So ultimately, in reviewing the documentation that was provided to you and through your interviews with Mr. Pasveer, did you ultimately render opinion of value as to MPIP and the assets held by MPIP?
We did.
And what is that value?
That value is, as stated on page 2, and also in detail in a later table, is $9,736,000 and change. It's rounded on page 2. It's detailed on I know it's here. It's detailed on page 12 with the actual final number, 9,735,852. $9,735,852 as the valuation on 9/30 of 2010 for MPIC intangible assets.
In rendering your value of opinion, did you determine that MPIP, as a result of the intangible assets that it held, performed above the industry standard?
We did. We found substantial margins over market, and that's one of the first steps we take in establishing a royalty rate for any entity that has IP, intellectual property, and claiming that it's valuable in their operation. Well, then we look at the net profits of the organization and compare it to market trends at the same level. In this case, EBITDA was a good example. So we look at, can we go to the document, go to the page that goes through that?
Yes, are you talking about the schedule?
On page 15, that's what we're doing here. It's a process that establishes the industry profit margins. You can see here at 5.14% compared to the royalty profits, well, the net profits of the subject assets of 19% plus. So there's a great variance there over market of 13.9%. That gives us the first indication there's value that's available that's in this company. Where is it? What is it? What's generating that additional free cash flow? At 14%, we certainly can't assign a 14% royalty rate to access this bundle of IP. We established an 8.673 rate that we thought was appropriate for the use of those assets. And on
So you discounted the rate, is that correct? You came up with a very high rate, but you discounted it.
Well, we discounted it several times. That's the first discount, yes. And is it discretionary? Yes, that's professional discretion on my part, applying that 8.63% rate. There's no way that we would see or could justify the full margin over that. So that's that's the rate that we had chose, and then that produces a royalty rate that we run over a 20-year period. These are long-lived intangible assets. That's not a depreciation schedule. That's the actual life of the asset. And on page 17, we demonstrate that in a table, attempting to show what we mean here. It's called the revenue roadmap. And this is the first year of royalties that we had determined at $1.9 million, but it was late in that year. So we went to the very next year, which increases by a small percentage of $2.06 million, and then rerun that over a 20-year period with a small price increase of that the industry market report tells us is the industry standard for annual increases. Then the critical part here is to see what happens when we come down to the net new client list and revenues for new client lists. What we're trying to demonstrate here is that over time, the content of the IP itself is shifting. New clients come and go. New technology comes and goes. And this is basically saying from the top line, you can see 100% allocation. It starts to trail off all the way down to 0 in year 20. The net new client list ramps up to 100%. So what this is demonstrating in a concise model is the content shifts. It changes. It's designed to do that. It's designed to roll and grow and add additional value. The prices are increasing, certainly, so we should expect additional value. And this is a table form trying to demonstrate that. So that's the next set of discounts is the discounting of those royalty payments every year for 20 years produces a net of value that we add up, and that is one of the valuation calculations. Two additional valuation calculations. One is called a terminal point. We take the same information and stretch it out forever, not a 20-year life cycle, a 4-life cycle. And what that is demonstrating is that's a method that we use to make sure we're capturing all the value on the tails. If you envision a bell curve, if you will, the center is the center of the bell curve is the tallest. It's a regular bell curve. What the terminal rate does is after about 38, 40 years, additional years incremental is so infinitesimal that over about a 40-year period, we capture all the value of that company if it were to diminish all of its assets. So that's what that's saying. That's a different calculation, a separate calculation. And then third, we've got, as seen in
Mr. Goshen, the report's been entered into evidence, and what I'm going to do at this point is I'm going to end my questioning because the report is in evidence, and if the panel has questions, I'm sure council might have questions, then we'll leave it to that. Okay. Is that, Judge Lee, is that fine?
That's fine.
Okay.
Thank you.
Thank you, Mr. Goshen.
Thank
Okay.
you.
Turning to the Franchise Tax Board, any questions for this witness?
Yes, thank you, Judge Lee. Just a couple. Mr. Gosen, I'm pronouncing your name correctly, correct?
It's Gossin.
Gossin, thank you.
Thank
I
you.
didn't want to mispronounce it. Thank you for clarifying. Okay. Just a couple of questions for you today.
Yes, sir.
First, your report was prepared in 2021, 11 years after the transactions at issue in this appeal, correct?
Yes, sir.
Okay. And then second, you didn't counsel or advise Mr. or Mrs. Pasveer or PaMaCo Incorporated regarding the transactions at issue in this appeal at any time during 2010, correct?
I'm sorry, I'm not quite clear.
Sure.
Did we advise them on?
Yes, the transactions at issue here took place in 2010. So during 2010, I want to confirm that you did not
I see.
advise them during 2010 regarding those transactions.
That is correct, we did not.
Thank you. And thank you for helping me clarify my question.
If I could add to that, because it's an important time to add it, we make sure that we go back and obtain reports, industry reports, for which this report's built on, in the time of the actual data value. So like the industry report that's in here, you can see it's dated 2010. And everything else that requires us to go back and obtain whatever information we're looking for, we have. So it's all relevant to that period of 2010.
Okay, thank you. In your report, and for reference, it's at Exhibit 33, page 10, you list as your sources of information for your report as the following: industry reports from the IBIS World Economic Reporting Database, financial statements from the operating companies, including some special purpose entities, industry reports from valuationresources.com on economic outlook for 5 years, client customer database and functionality, client interviews, professional service provider interviews with the legal advisors at Lobb and Plu LLP, and lastly, the NYU Stern School of Business weighted average cost of capital annual publication. Is that correct?
Yes, those are the sources that we use.
Great. And as confirmed by Mr. Pasveer's testimony today, you'll recall he indicated in the report from Avalon, the appraiser who conducted the appraisal in 2010, and this is at Exhibit K at page 4. Mr. Pasveer confirmed that he had supplied Avalon copies of internally prepared lists and descriptions of identifiable and tangible assets, organizational structure, 24-month operational forecast. notably in your report, you don't list any, you don't indicate that Mr. Pasveer ever supplied you copies of internally prepared lists or descriptions of identifiable intangible assets, correct?
I don't know if I could actually agree with that as a yes.
Okay.
He did provide information. I mean, it's in our work papers of the financial conditions. You can see what we put together on page 18. Those subsets, those entities make up the revenues. They make up the cost of goods sold. So that was provided to us.
Okay. It just wasn't listed in your sources of information on page
I see.
10.
Yeah,
Okay. Thank you.
sure.
That's all. Thank you so much.
Thank you. Let me turn to the panel. Judge Lambert, any questions for Mr. Gosson?
Hi. Yeah, I just had one question.
Yes, sir.
I was looking at the report and listening to what you're saying, but I was just, maybe you could clarify, did you look at income from before 2010 actual income, or do you just project the 2000 income forward?
Sorry. No. We looked at 1 year prior, and that's listed on page.
Oh, okay. I see 2009.
See that? Yeah.
Okay. And
Yeah, that's 2009, 2010, and then we were in a position to say, well, what did 2011 look like? And so that's an estimate, 2011. 2010 obviously is there. The adjustments we make to those numbers are shown at the bottom. And in this case, 2009, 2010 was producing a discrepancy between EBITDA and EBIT numbers. In 2009 was considerably lower than it is in 2010. A valuation professional will take that and say, well, we want to make sure we're gathering as much free cash flow as we're allowed to. So we added those together and divided them by 2 and came up with a net number that makes sense. So in other words, we're giving some profit away here to come up with the $6,725,000. Now, in our actual royalty rate assessment, we take those 2 and weight. It's a weighted average. Other than that, that's what that is. I think it's probably appropriate to say on page 13 are the capital charges that bring the intangible assets into any project that Mr. Pasveer adds this IP to. And these are the capital charges that would go on that entity's cost P&L. So we end up with a net value, net of capital charges, to put this intellectual property into the entity that it's going to work in. And those are the 3 value calculations. You can see that weighted average on page 13 is the exact same number, $9,735,852. That goes on to the data sheet and into the description and final conclusion. So that's a pretty good overview of how that's brought about.
okay, thank you. Appreciate it. And
Of
that's all-
course, yes.
That's all I had.
Thank you, Judge Lambert. Judge Stanley, any questions at this time?
Yes, first, for the record, can you say what EBIT is? If you use acronyms, our
I'm sorry.
receptionist
Yeah, of
will
course.
just
Yeah.
get
And
an acronym.
EBIT is not heard or not used as much as EBITDA, but it's earnings before interest and tax.
Thank you. And then my real question is, why did you select, or did your client select a valuation date of September 30th, 2010 instead of July 1st, 2010 when the trust was created?
That's a date that was given to me as I knew it had to be somewhere in late 2010. The month end of September is what was given to me. There was no reason other than that I know of.
Okay, thank you.
You're welcome.
Thank you, Judge Stanley. Does this conclude appellant's presentation?
It does.
Thank you.
Yes, it does.
Thank you. Okay. At this time, we're going to go ahead and take a recess for 1 hour. We're going to go off the record. Please mute the mic. We will return at 1 p.m. I would also like to let the parties know that we will open the security room 15 minutes before 1 p.m. to allow security screening. Thank you.
Judge Lee, is the expert witness relieved? Can he leave now, or does he need to be here when we resume?
I think it'll be best if he just stays, just in case there are additional questions after FTB's presentation.
Okay, very good.
Is that
Thank
okay?
you.
Okay, thank you. Looks like everyone is settled in. I've been asked to perform a mic check at this time, so let's go ahead and do that. Respondent.
Good afternoon.
Thank you.
Hello.
Thank you.
Good afternoon.
Thank you.
Good afternoon.
Perfect. And at this time, let's go back on the record. I'd like to provide reminders to the parties to please try to directly talk into your microphone. Sometimes when the parties are looking at documents or looking left and right, they're not talking directly to the microphone. That makes it sometimes hard to hear. So please try to talk directly into your microphone. Before recess, appellant's presentation had concluded, and so now we're turning to the FTB's presentation. You may begin when you're ready.
Thank you. In 2010, appellants Marinas and Miriam Pasveer and PaMaCo Inc. devised an abusive tax avoidance transaction, commonly known as an installment sale bogus optional basis transaction, or an IBOB for short. As described by the IRS and the United States Government Accountability Office, in an IBOB, a taxpayer uses a network of entities they own or control to artificially increase an asset's basis to reduce or eliminate capital gains taxes when the asset is sold. In a simplified example provided by the Government Accountability Office, the players in the scheme commonly include a taxpayer who is a 100% owner of an LLC that owns a single capital asset. If the taxpayer were to sell the asset to an independent third party on the open market, the taxpayer would pay the difference between the amount realized and the adjusted basis, or the gain. In the IBOB, the taxpayer instead creates a new entity that they control, such as a family trust. The taxpayer transfers to the trust 99% of their interest in the LLC and the single capital asset in a fictitious installment sale. By doing this, the LLC can make an election under Internal Revenue Code Section 754, 734B, and 743B. The LLC can elect to step up the basis in its asset for the new partner, the family trust, so the trust share in the LLC's basis, and the LLC's basis rises from the original basis to whatever the trust paid. The installment payments are typically never made, or if they are, yes.
If you can slow down while you're reading.
Correct. Got it. The installment payments from the trust to the taxpayer are typically never made, or if they are, the other terms of the sale are not enforced because the transactions are not at arm's length, as all parties are owned or controlled by the same taxpayer. By artificially raising the basis in the asset, the taxpayer effectively lowers or even eliminates any capital gains taxes upon the ultimate sale of the asset to an independent third party. All the taxpayer had to do was create entities they controlled and manipulate asset ownership among the entities. In this case, appellants used a similar scheme to artificially increase the basis of purported assets through a fictitious installment sale like the preceding example. Appellants further used a series of bogus licensing fee and corresponding deductions for the same purported assets among a network of entities owned or controlled by Mr. and Mrs. Pasveer. Today I will explain how appellants created this abusive tax avoidance scheme to offset $3,529,787 in income, and manufactured a circular flow of money wherein appellants essentially leased purported intangible assets to themselves. The evidence will demonstrate that the fictitious installment sale and lease of purported assets lacked valid business purpose and economic substance, and that should therefore be disregarded for income tax purposes. I will begin by introducing the players in this IBOB, Mr. and Mrs. Pasveer, PaMaCo, which I will refer to as the S Corp, MPIP LLC, which I will refer to as the LLC, and the Pasveer Children's Trust, which I will refer to as the Trust. I will explain the timeline of the transactions at issue, which will highlight the tax avoidance purpose of the transactions. I will then discuss the relevant law and analysis showing that the transactions at issue lacked economic substance and should be disallowed, and that the penalties imposed should also be upheld. For the years in question, tax years 2010, 2011, 2012, 2013, and 2014, the S Corp was wholly owned by Mr. Pasveer, who also served as the CEO. The company mainly received consulting service income from the other entities directly or indirectly owned by Mr. Pasveer, otherwise known as the Pasveer Group of Companies. Appellants allege that at some point, Mr. Pasveer created intangible assets or trade secrets. On June 29, 2010, Mr. Pasveer assigned these purported intangibles to the LLC for a 100% membership interest. The agreement was signed by Mr. Pasveer as a signor and Mr. Pasveer as the manager for the LLC. The purported intangibles included financial control and reporting services, profit and cash flow management and investment services, client database and evaluation, and others. As set forth in FTB's Exhibit A, the LLC stated the purported intangibles incurred zero development costs and had no accompanying title or patent before or after contribution to the LLC. The LLC was formed the same day Mr. Pasveer assigned the purported intangibles. In its tax filings, the LLC describes itself as being in the management service business. However, appellants have conceded that the LLC does not provide any management services. This is found in FTB's Exhibit E. The only income the LLC reported was from the S-Corp, pursuant to a royalty agreement, which was entered into the same day the LLC was formed. Under the terms of the royalty agreement, the LLC leased the purported intangibles to the S-Corp for an initial signing bonus of $710,000 plus annual payments of $1 million. The royalty agreement was signed by Mr. Pasveer, the manager of the LLC, the licensor, and Mr. Pasveer as president of the S-Corp, the licensee. On July 1st, 2010, Mr. and Mrs. Pasveer settled the irrevocable Pasveer Children's Trust with an initial nominal contribution. On the same day, Mr. and Mrs. Pasveer sold their 99% of their interest in the LLC to the trust for $10,700,000 in an alleged installment sale in exchange for a promissory note. The note initially named the trust as the maker and the LLC as the holder of the note, which provided that the trust would pay the principal of $10.7 million no later than June 30th, 2025, at an interest rate of 3.28%. The note was later modified on January 1st, 2013, naming Mr. and Mrs. Pasveer as the holder of the note and reducing the interest rate to 0.87%. The trust made zero principal payments on the note in 2010, 2011, or 2012. The trust made its first principal payment in 2013 and its second principal payment in 2014. As a result of this alleged installment sale, the LLC made IRC Section 754, 734B, and 743B elections to adjust the basis of the LLC's property for tax year ending December 31st, 2010. The LLC reported a step-up in basis of $10.7 million. On October 8th, 2010, over 3 months after Mr. and Mrs. Pasveer allegedly sold the 99% interest in the LLC to the trust, Mr. and Mrs. Pasveer obtained a valuation opinion of the fair market value of the LLC. The report claims to assess the fair market value of the LLC, including its single asset, the purported intangibles, as $10.7 million. The analyst who prepared the appraisal interviewed Mr. Pasveer, who purportedly supplied copies of internally prepared lists and descriptions of intangible assets, the organizational structure of the company, financial information, and a 24-month operational forecast. Notably, these documents have never been provided to FTB or OTA. Because the appraisal was done months after the LLC interest was sold to the trust, the report does not indicate how the purchase price of $10.7 million was determined at the time of sale on June 30th, 2010. Furthermore, even though the report gives a valuation of only the LLC, the report considers the value of the whole Pasveer group of companies owned directly and indirectly by Mr. and Mrs. Pasveer. The report also based its valuation on the assumption that the LLC would provide management services and receive payments from all companies in the group. However, the LLC never provided services or received income from any entities other than from the S-Corp for the licensing fees. So to summarize the events of 2010, on June 29th, the Pasveers formed the LLC and assigned purported intangibles to the LLC in exchange for a 100% membership interest. In other words, Mr. and Mrs. Pasveer assigned purported intangibles to themselves. The next day, Mr. and Mrs. Pasveer arranged the licensing agreement between the LLC and the S Corp. In other words, they licensed the purported intangibles to themselves. On July 1st, Mr. and Mrs. Pasveer created the trust and supposedly sold 99% of their interest in the LLC to the trust. In other words, they sold the LLC to themselves. The valuation report for the LLC was completed on October 8th, 2010, over 3 months after the alleged sale was consummated. As a result of these transactions, Mr. and Mrs. Pasveer, the S Corp, the LLC, and the trust created a circular flow of money, which can be summarized as follows. The S Corp paid licensing fees to the LLC and claimed deductions for these fees. The LLC reported the licensing fees as income, which it offset with corresponding and nearly identical amortization deductions. And the trust received income as 99% member of the LLC, which it then paid to Mr. and Mrs. Pasveer as alleged payments on the promissory note. FTB has disallowed the alleged sale of the LLC interest to the trust and has also disallowed the S Corp's reported licensing fee expense deductions. FTB's disallowance of the S Corp's deductions resulted in corresponding increase to the Pasveer's flow-through income from the S Corp. This formed the basis for the notices of proposed assessment and subsequent notices of action at issue here. The first issue here is whether FTB properly disallowed these transactions because they lacked economic substance and a non-tax business purpose. As set forth in the United States Supreme Court case Gregory v. Helvering, while taxpayers are generally allowed to structure their business transactions in a manner that it considers the effect of taxes, a taxpayer does not have the right to avoid taxes by structuring transactions lacking in economic substance. The economic substance doctrine is a judicial doctrine that prevents taxpayers from subverting the legislative purpose of the tax code by engaging in transactions that are fictitious or lack economic reality to simply reap a tax benefit. The Ninth Circuit case, Pasveer v. Commissioner, established a two-pronged test to determine or to decide whether a transaction has economic substance. The first is a subjective business purpose inquiry into the taxpayer's stated motives for engaging in the transactions, and the second is an objective economic substance analysis of the business and practical effects of engaging in the transactions. In the appeal of Allen, the California State Board of Equalization confirmed that the factors set forth in Pasveer apply for California income tax purposes, and the Office of Tax Appeals adopted the two-part test in appeal of La Rosa Capital Resource, Inc. and appeal of Gatewood Corporation. In examining the first prong, the subjective business purpose test, appellant's stated purpose for the transfer of the purported intangibles to the LLC, the licensing deal between the S Corp and the LLC, and the sale of the Pasveer's interest in the LLC to the trust was for estate planning purposes, and that these transactions reflect, quote, textbook estate planning techniques, end quote, and that's in their brief. However, much like the transactions at issue, appellant's argument is circular. It presumes mere estate planning purposes are sufficient to pass the business purpose prong. Appellants have not cited any controlling legal authority that has found similarly structured transactions to have a legitimate purpose, and they have also cited no controlling legal authority supporting their assertion that estate planning for personal finances can be a legitimate purpose to satisfy the business purpose test. The LLC itself lacked business purpose. It had no business activity during the years in question whatsoever, and appellants conceded that the LLC does not provide management services. The only income the LLC received was from the S Corp from the licensing agreement. The purported sale of the LLC interest to the trust lacked business purpose. There is no documentation contemporaneous with the sale that justifies the sale price of $10.7 million. Rather, it wasn't until October 8, 2010, that a valuation report conveniently valued the LLC and its single asset at the same time, at the same exact price that the trust paid Mr. and Mrs. Pasveer months earlier. And we did hear that there are potentially drafts of that document, but we've never been provided with those. The only copy that we have is October 8th, 2010. There are also no patents or other intellectual property documents associated with the alleged assets, and the only documentation of these purported intangibles appellants provided to FTB consists of lists describing the services and purported knowledge that Mr. Pasveer accumulated during his career. It is doubtful whether these intangibles even existed, let alone whether they were legitimately valued at $10.7 million. The trust lacked business purpose. It maintained nominal assets during all taxable years at issue, and at no point had sufficient capital to purchase the LLC interests from Mr. and Mrs. Pasveer. The trust had no business activity or transactions other than the so-called purchase. The trust's only funds were the distributions from the LLC, which the LLC received from the S-Corp. The timeline of these transactions lacked business purpose. Within the span of 3 days, Mr. and Mrs. Pasveer created the LLC, transferred the purported intangibles, created the licensing agreement, created the trust, and sold their interest in the LLC to the trust. Based on the foregoing, there were no non-tax business purposes for these transactions. The S-Corp paid the licensing fees to the LLC, which then paid the trust, which then paid Mr. and Mrs. Pasveer. These transactions were merely a mechanism for appellants to pay themselves and claim bogus deductions to offset income. Therefore, they fail the subjective business purpose prong of the economic substance analysis. The second prong of the economic substance doctrine considers the objective economic substance analysis of the business and practical effects of engaging in the transactions. Courts have used different measures to determine the economic substance of a transaction, such as the legitimate or realistic possibility for a pre-tax profit. This was held in the Second Circuit Court of Appeals case Gilman versus Commissioner, and whether the taxpayer has shown that the transaction resulted in a meaningful and appreciable enhancement in the taxpayer's net economic position, other than the tax consideration. And this was held in the U.S. Supreme Court case Netsch versus the United States. In considering the possibility for a pre-tax profit, there must be a reasonable expectation that non-tax benefits will meet or exceed transaction costs. As held in the Netsch case, offsetting legal obligations or circular cash flows may effectively eliminate any real economic significance of the transaction. Here, the purported sale of an LLC interest allegedly worth $10.7 million did not provide a non-tax economic profit. It was just a means to a tax avoidance end. Appellants allege that Mr. and Mrs. Pasveer profited from their structure and that the LLC will profit from the royalty agreement. However, appellants seem to forget that the $10.7 million purported gain was offset with the S-Corp's licensing fee expense deductions, which reduced the Pasveer's flow-through income from the S-Corp. This offsetting legal obligation and circular cash flow effectively eliminated any real economic significance of the transaction. As for appellants' argument that the LLC will profit from its licensing activities, let me remind you that the LLC reported zero income during the taxable years at issue other than the licensing fees it received from the S-Corp. The questionable existence of the purported intangibles also cast doubt on the possibility of profit, as no reasonable person can expect to profit on the sale of fictitious assets. Next, we examine whether there was any meaningful enhancement of appellant's economic position due to the transactions at issue. In this case, Mr. Pasveer was the sole shareholder of the S-Corp, and Mr. and Mrs. Pasveer were the sole members of the LLC before the purported sale of their interest to the trust. Mr. Pasveer signed his own name on behalf of both parties on the royalty agreement between the LLC and the S-Corp. Appellants claim that the trust was independent because it was managed by a trustee. However, the original trustee was Lawrence Stevens, the accountant and return preparer for the appellants in the Pasveer group of companies. As set forth in FTB's Exhibit M, Mr. and Mrs. Pasveer stated that they relied on the advice of Mr. Stevens in the creation of the trust and the purported sale of the Pasveer's interest in the LLC to the trust. Following Mr. Stevens' resignation from the trustee position, the Pasveers appointed So-Von Feng as a trustee. However, we know now that Mr. Feng is or has been employed by Exterior Cladding Systems Incorporated, one of the constituent entities of the Pasveer group of companies during the years at issue. That Mr. and Mrs. Pasveer appointed Mr. Stevens the architect they used to construct this whole scheme, and Mr. Fang, yet another member of the Pasveer extended corporate family, exposes that the trust was likely never intended to be independent. The Pasveers were also able to decide when and how the trust would make payments on the promissory note. They modified the note to reduce the interest rate from 3.28% to 0.87%. The trust made zero principal payments on the promissory note in 2010, 2011, or 2012, and incurred no late payment penalties. The trust is therefore nothing but a straw man controlled by Mr. and Mrs. Pasveer, allowing them to funnel money through their network of controlled entities back to themselves. Based on the foregoing, the transactions at issue fail both the subjective business purpose and objective economic substance prongs of the economic substance analysis. Office of Tax Appeals has requested that the parties address whether IRS Revenue Ruling 2024-14 applies here, and whether the economic substance doctrine applies to transactions involving trusts. Through a series of examples involving related entities, Revenue Ruling 2024-14 essentially states that certain basis-shifting transactions between partnerships and related entities do not have economic substance as defined under Internal Revenue Code Section 7701, Subdivision O. In each of the examples provided in the ruling, the related parties exploit disparities between inside and outside basis by first creating and then capitalizing on the disparity by either transferring a partnership interest in a non-recognition reorganization transaction or distributing property to a partner, after which the partnership claims a basis adjustment. The ruling states that the resulting inflated basis adjustment does not change the economic position of the related parties. It only increases the depreciation deductions or reduces gain upon future sale of the property involved. As you may already notice, strikingly similar facts are present in this appeal. Related parties, the apparent shuffling of property among them, artificial basis increases, bogus deductions, and the almost certain reduction or elimination of gain upon the future sale of property. In this case, of course, we have the additional facts that the taxpayers generated the bogus deductions by licensing intangible assets to themselves, and the looming question of whether these assets existed in the first place. As for whether the economic substance doctrine applies to transactions involving trusts, the IRS has identified several types of abusive trust schemes, both foreign and domestic, and courts have applied the economic substance doctrine to transactions involving trusts. In one example, in the Ninth Circuit case Zmuda versus Commissioner, the court applied the economic substance doctrine to transactions involving not just one, but 3 trusts. The taxpayers served as trustees of one trust, which in turn acted as a trustee for a second and third trust. The taxpayers transferred income-producing property into the second trust in exchange for certificates of beneficial interest, which they sold to the third trust. The second trust loaned money to the taxpayers in exchange for promissory notes, which were then gifted to the taxpayers, resulting in approximately $21,000 in alleged tax-free income. The court found that the taxpayers had complete control over the trust property, and the trust engaged in no trader business, and that the transaction lacked economic substance. In the precedential OTA case, Appeal of La Rosa Capital Resource Incorporated, this body upheld a non-economic substance transaction penalty to a transaction that purportedly sought to combine 2 existing trusts and avoid estate taxes. But OTA found that there was no profit-seeking motive or economic substance in the transaction. Clearly, tax consequences of a transaction depend on the substance and not form, and the economic reality of a transaction is independent of the types of parties involved in the transaction, including trusts. The next issues in this case is whether appellants have established that the non-economic substance transaction, or NEST penalty, under Revenue and Taxation Code Section 19774 was improperly imposed. The NEST penalty adds 40% of the amount of NEST understatement. In this case, the MPA included the NEST penalty based on a determination that appellant's purpose for the licensing of purported intangibles from the LLC to the S-Corp, the alleged sale of 99% of their interest in the LLC to the trust, and the LLC's step-up in basis of $10.7 million were solely for tax avoidance purposes. As previously discussed, there is significant evidence showing that the steps taken in these transactions lacked any real business purpose. Rather, the purpose was the generation of deductions that offset $3,529,787 of the past year's flow-through income from the S-Corp. Therefore, the nest penalty was properly imposed. For the interest-based penalty, if a taxpayer has a deficiency attributable to an abusive tax avoidance transaction and has been contacted by FTB regarding such transaction, Section 19777 imposes a penalty equal to 100% of the interest payable. As with the nest penalty, FTB properly imposed the interest-based penalty because the transactions at issue lacked economic substance. Appellants were notified during audit that these transactions lacked business purpose, and that the only anticipated tax benefit was tax avoidance. For these reasons, FTB properly imposed the 100% interest-based penalty. Lastly, appellants argue that their federal audit for 2013 is dispositive here and rely on Section 16.1 of FTB's Manual of Audit Procedures, which states that, quote, if the IRS has examined and changed or no changed an issue, we will not pursue it unless there is clear information to show that the IRS was wrong. This is a rare event, end quote. However, appellants ignore Section 1.1 of the same manual, which clearly states that the manuals provided for the guidance of audit staff are not authoritative and may neither be cited to support an audit position nor relied upon by a taxpayer. Instead, the manual is a resource for understanding audit procedures and guidelines. Section 16.1 also contemplates, explicitly, that the IRS may be wrong. But more importantly, appellant's argument begs the question that the IRS had already examined these transactions before FTB did. In fact, FTB first contacted appellants about audit selection on February 26, 2015, whereas the IRS did not make contact with them until June 22, 2015, and November 18, 2015, as identified in Appellants Exhibits 12 and 14. Furthermore, FTB's audit findings predate the IRS's notices of no change audits. FTB issued its audit findings to the Pasveers on March 2, 2016, whereas the IRS issued its no change audit on March 31, 2016, as identified in Appellants Exhibit 21. For PaMaCo, FTB issued its audit findings on March 2, 2016, and the IRS issued its no-change audit to PaMaCo on November 18, 2016, as set forth in Appellants Exhibit 22. Therefore, not only did FTB initiate its own audit before the IRS, FTB issued its audit findings before the IRS issued its no-change audit letters to the Pasveers and PaMaCo. As a reminder, Section 16.1 states that generally, FTB will not pursue an issue if the IRS, quote, has examined, end quote, an issue. Clearly, the IRS had not examined the issue when FTB began its audit. At most, it appears the audits were conducted concurrently. But even if the IRS had already examined all transactions at issue, Section 16.1 clearly contemplates that the IRS may in fact be wrong. And while this may be a rare event, it's not impossible or an unimaginable event. Here, the IRS did not perform a full audit of the returns of all taxable years at issue, nor did it provide any analysis of the transactions at issue. It merely issued no-change audit letters to appellants for 2013 after FTB had already completed its analysis of the transactions for 2010 through 2014. Therefore, FTB is not bound by the IRS's no-change audit letters. In conclusion, appellants have failed to show that the transactions at issue have economic substance. Appellants insist that they followed textbook estate planning techniques when they really followed a textbook basis shifting tax scheme. Therefore, FTB requests that OTA sustain the notices of action issued for 2010 through 2014. Thank you.
Thank you for your presentation. Let me turn to the panel. Judge Lambert, any questions for respondent?
Hi, I had one question. just to like confirm or just clarify, finding non-economic substance, that the transaction lacks economic substance under issue 1, looking at case law, is that the same as finding a non-economic substance transaction under the NEST penalty under RNTC section 19774? So basically, if you find there's no economic substance under issue 1, does that mean that in the NEST penalty applies in terms of non-economic substance, so they're basically the same?
Can I ask for clarification on that question, Judge Lambert?
Yeah, under RNTC section 19774. Sorry.
No, it's okay. My question was, when you refer to issue 1, are you referring to prong 1 of the economic substance doctrine, or?
Yeah, just the economic substance portion of it, I mean.
That's okay, the second prong.
Yeah, okay,
right.
yeah.
Well, the economic substance doctrine, in order for a finding of economic substance, of non-economic substance, either prong can be faulty. So even if a prong is met, if they don't meet both prongs, then a finding can be found for that a transaction lacked economic substance. And for any transaction that lacks economic substance, the NEST penalty can't be applied. Does that answer your question?
Yeah, so basically if you find non-economic substance in that prong, the NEST penalty in that portion would be applicable because the analysis would be the same?
I'm still not sure if I understand your question. A finding of non-economic substance can be found by either prong failing. So if it lacks a business purpose or economic effect, then a determination of that it lacked economic substance can be made.
Okay, because so there's the business purpose portion, and
Correct.
that maybe it's one where it's different. Okay. Okay, thanks. That was my question.
Thank you, Judge Lambert. Judge Stanley, any questions for a respondent?
Yes, that just raised more of a question, that answer, in my mind anyway. So what I think Judge Lambert was trying to differentiate is if you find that it fails under the business purpose test, then it is a finding of lack of economic substance, is what you're saying, which means that the NEST penalty would necessarily apply?
It could apply, yes. If the OTA finds non-economic substance, then the NEST penalty will apply, yes.
And you're saying that under either prong, if it fails, that we are making a finding of non-economic substance?
Well, it's your finding to make, but I would argue for that, yes.
Yeah, no,
Yeah.
I'm just looking for your position. If we make a finding under either prong, you're still saying that we're making a finding of non-economic substance.
I think I agree with your statement.
Okay. I am going to hold questions because I think that Mr. Lobb might respond and provide the other information that I was interested in.
Okay, thank you, Judge Stanley. I do have a few questions right now. You mentioned IBOG. Can you tell me again what that stands for?
Installment sale, installment sale bogus optional basis transaction.
Okay, and was this concept mentioned in FTB's briefs?
It was mentioned in our audit issue presentation sheets that were provided to the taxpayer. I'm not sure it was mentioned in the brief.
Thank you. Let me ask a separate question. In regards to interest concession that have to be made, I just want to be clear on what that applies to.
Okay.
So FTB concession to abate interest for the period April 7, 2017 through July 25th, 2019. This applies to both PaMaCo and the Pasveer.
Correct.
Okay. Second, there are two items that relate to interest, and that's first the 100% interest-based penalty, and second, that's interest under 19101. Does that make sense?
Just the interest that has accrued?
Yeah.
Yeah,
Okay.
correct.
So, which interest is your concession? Does your concession apply to?
So we're conceding the interest for that specific period. So my understanding, and please correct me, is that interest will be relieved for that period, and there would be no corresponding interest-based penalty for that period.
I think that's right. And to be clear, one is interest and one is a penalty.
Okay.
So it's not two interests. It's one is interest and one is an interest or a penalty based on the interest.
Okay. So to the extent that there was interest-based penalty running during those period, then you're conceding the 1% interest-based penalty.
Yes.
Yes.
Okay. I guess the way I understand the interest-based penalty, it runs from the return due date to when the NPA was issued.
Correct.
So I think in this case the NPAs were issued in 2016.
Yes. The penalty is actually on the MPA. It shows the amount.
Yeah.
So any abatement of interest after that date would not be affected, or the interest penalty would not be affected by that. So I think for this abatement period, you're right.
Okay.
Would not be reduced.
Okay, I understand. So FTB.
I hope we clarified that. Sorry about that.
Okay, so FTB is conceding to abate interest as the interest that's under 19101, not the interest-based penalty, because the interest-based penalty wasn't running at the time.
Correct.
Correct.
Okay, thank you. Okay, that's all the questions I have right now. Let's turn it to appellants for their closing statements.
So thank you, Judge Lee. I'm going to comment on some of the presentation that was just made, and then Elaine Serrao will comment on Revenue Ruling 2024-14, if that's okay.
Okay.
Okay. So I was quite surprised that there's some argument being made that this is a Bob transaction, because if you read about these Bob transactions, the fact pattern is completely different. And as was evident in the testimony that was somewhat ignored here was counsel immediately went into that under this transaction it reduces or eliminates cap gains when sold. Those cap gains occurred on day one when the sale took place because it was a non-grantor trust. There was only one way to report this. There was not another way to report this. You had to report the sale and pick up the gain. Now, it's an installment sale, but that doesn't mean cap gains go away. You pick them up, and you're going to pick up that cap gain twice. You're going to pick it up the first time when you do the sell, which is what happened here on the installment sell. You're going to pick it up again when that trust, if that trust ever sells that asset. So the cap gains don't go away. He then said that installment payments are never made on these Bob transactions. Here, the testimony that we have is that the installment payments have been made all the way through today's date. And as a matter of fact, since the audit period started, there has been no expense deduction taken by PaMaCo. They paid taxes, and the taxes have been made on the installment sale to the taxpayer. And that has continued through today's date. So these facts that support a Bob transaction, they don't exist here at all. Counsel shows up today and gives us a piece of paper that shows that one of the independent trustees, Sylvan Fang, owns a company called Exterior Cladding, and counsel says in his closing that shows that he's an employee of Mark Pasveer. Mark Pasveer specifically testified that he's not an employee, that he sold this company to this gentleman. The gentleman was renting from him, and then he's since moved to a different facility. That's the fact that is in evidence right now is completely contrary to what counsel just read off his piece of paper. Going into, counsel says that it's a related party transaction, and if you go into, and Elaine will talk about this on Revenue Ruling 2024-14, and also in regards to these Bob transactions, they talk about related party transactions and related partnerships. Here, you have a non-grantor trust that under the Internal Revenue Code is specifically an unrelated party, and that's why you pick up the gain on day one when the sale transaction takes place. Counsel infers that if in a year a payment is not made on a promissory note, that somehow that makes a transaction wrong or inappropriate. No, this happens all the time on installment sales. But what we know is that payments have since been made, and they continue to be made to the tune of millions of dollars, and the gain has been picked up. So taxes are being paid, and when I hear the argument that this is a Bob transaction, or I hear the argument that no taxes are being paid, or that there's no substance to the transaction, I'm bewildered. I was sitting here shaking my head listening to that because the facts are completely the opposite. Taxes have been made, and as a matter of fact, at the end of the day, Mr. Pasveer will pay more in taxes than had this never happened. But what he is going to have at the end of the day is an estate plan for his daughters that holds a very valuable asset that when his 706 return is filed, the appreciation and the value of the assets in that trust will be out of his estate. That's why people do estate planning of this nature. There are thousands and thousands of these trusts in this country, and for this very purpose. This type of installment sale happens all the time. Counsel seems to be confused on the concept of intangible assets. He says there's no intangible asset because there's no patent. Intangible assets come in many forms. You have intellectual property consisting of copyrights, trade secrets, patents, and trademarks. And then you have intangible assets such as vendor lists, which is what was in the Martin Ice Cream case, or a customer list that we cite in the brief in the Howard case. But in the Howard case, the tax court disallowed the allocation of the goodwill because there was a non-compete in place. Here, there's not a non-compete. So the customer list can remain the asset of the individual as opposed to the entity. And that's what we have here, and that's what the testimony was. One other point, and I somewhat understand the confusion by counsel on the structure, and that was that PaMaCo was the hub entity for the payments coming through on the royalties and the management fees. That was PaMaCo, and that was testified to by Mr. Pasveer. PaMaCo was the one to collect those monies and then pay them on the licensing arrangement with MPIP. And so that was the structure. If there's something to be said for taxes here, it's that because of the amortization, there was a deferral. That's the one thing that could be said was the benefit to the taxpayer here. It wasn't elimination, it was a deferral. Because the amortization offsetting that income coming through, ultimately the taxpayer picks up the tax when the payment on the installment note is made. So there is a deferral, but what happened here is very interesting. The taxpayer deferred income into higher tax rates because over time and over the years, the effective tax rates in the state of California have gone up. Had he paid all of the tax and not done the installment sale, he would have picked up a lower marginal rate. As far as the documentation that counsel says was not provided, for an example, I think he was inferring that earlier that we did not provide the revocable living trust, the whole estate plan of Mr. Pasveer, and some other documents that conceivably the valuation expert had. We provided documents with respect to every category that was requested. Today there were some requests that came through that honestly we didn't realize they had ever wanted or asked for or necessarily needed. I don't really know why some of the documents that he's complaining about were necessary for any part of the analysis here. Their analysis is very clear. This is a Bob transaction, and there was no taxes paid, which is just obviously not the point, and those documents would never get them past that issue. So the documents don't lend to anything on their analysis, in particular the entire estate plan. I don't really know where that comes into play. I think of situations where there are deferrals all the time, and deferrals aren't always good. So if you do receive a deferral on the payment of tax, in fact, sometimes it can be quite harmful. If you, for instance, do not do a Roth IRA or you don't do a Roth 401k, you're deferring it into the future, and we don't know what the tax rates are going to be in the future. So I don't really know what can be said about an argument that there's no economic substance because there's a deferral, because that's basically the argument at this point. And that's an argument that I don't think falls within any of the case law as far as economic substance. It just doesn't support that type of claim. There's a minor point I'm going to make, and then I'll turn this over to Elaine. The IRS examination was not really concurrent. Yes, the FTB did start, but then they stopped. The IRS then completed their examination, and then the FTB started their examination, and lo and behold, 10 years later, here we are. But the IRS did close out their examination and provided the no change a very long time ago. I understand that they can decide that the IRS was wrong, which they've done, and they're moving forward. But I don't think we need to wrestle with who completed their examination first. The IRS has been done for a very long time. And then the Bob issue, too, I found surprising because it's not in their brief. And to me, it just seems like grabbing at straws at this point, because the Bob transaction talks about related party transactions, and that's specifically not what we have here. So on that note, I'll turn it over to Elaine to discuss 2024-14, and I think maybe something on the NEST application and the NEST penalties.
With respect to Revenue Ruling 2024-14, it presents three scenarios which are inapplicable to the instant matter. In scenario number one, there's a non-recognition transfer pursuant to 721, which allows for the basis shifting. In scenario number 2 and 3, the basis shifting is a result of 731 current and liquidating distributions, all three of which are non-recognition events. With respect to the instant matter, yes, Mr. Pasveer capitalized the intellectual property into MPIP, which is a 721 non-recognition transaction, but we do have a subsequent sale, which is where tax has been recognized to the Children's Trust. So the application of 2024-14 is, again, inapplicable specifically because each scenario, the basis shifted as a result of non-recognition transactions, as opposed to here where we've got a sale pursuant to a third-party valuation establishing the sales price, which allowed for the 754 election.
Thank you. And are you also planning to discuss the NEST penalty?
No.
No. Okay. With that, does that end your closing remarks?
Yes, it does. Thank you.
Thank you. Let me turn to the panel one last time for final questions. Judge Lambert, any final questions for either party?
I had one question for appellant. Just going off of what FTB said on the profit purpose, I was just wanting to ask or have clarified what, other than tax, effects, what the difference would have been for PaMaCo and business in general if there had been no creation of the trust or transfer of the IP. How would it have made a difference for the business?
For the business, the conglomerate business, or PaMaCo, or MPIP?
Yeah, not MPIP, because I think that was the one that was created. But just if they're licensing the IP to PaMaCo, which was related to all the other business, the business in general, how did it make a difference for just business and if it had not been done in the first place? Or what difference did it make exactly?
Well, it makes a huge difference in a lot of different ways, and let's start with there being a corporate asset. So we know from tax court cases in particular, and I've mentioned Martin, but there's many other cases that we had cited where it's recognized that MPIP, neither MPIP nor any of the conglomerate entities owned the intangibles. Those were owned by Mark Pasveer. So PaMaCo and the other entities had no right to use the customer list, and they had no right to use the intellectual property. By signing a contract, by entering into a licensing and royalty arrangement, that entity now has a contractual right to use those assets, okay, and enforcement rights from a intellectual property standpoint under the licensing agreement, the trademark specifically. So now it has a contractual right, and that helps the business of PaMaCo. Otherwise, what would happen is you would have a scenario where PaMaCo was not really entitled to any of it whatsoever. But it's important in the context of asset protection because now we know, and we heard the testimony, that in the construction industry, litigation is rampant, and it's a concern of people involved in that industry. That is why Mr. Pasveer early on was creating entities. If one of the entities went down, those assets would not be held in that entity. They're held in MPIP, and there's a licensing arrangement. So there's the ability to break that contract and sever the relationship with the debtor entity and continue on in business, which is a very, very valuable thing. And by the way, this happens across the entire world all the time, and normally you see it in bigger companies. So bigger companies typically will house their intellectual property outside of the main operating entity for tax reasons, but also for asset protection purposes and enforcement reasons. So there is a lot of reasoning behind doing this that is completely untax related. But then again, I want to go back to the point that, and this didn't really help anything tax-wise. There may have been a deferral, but that deferral ultimately did not eliminate tax, number one, and number two, it deferred tax into a higher tax regimen.
Okay, thank you. Appreciate it.
Thank you.
Judge Stanley, any final questions for either party?
Yes, also for appellant, and it ties into what Judge Lambert just asked. We have gotten over the course of these many hours and with all the briefing that there is a major disagreement on the tax ramifications of these transactions, but there's been little said on the on the reasons for the structure, the business purposes for structuring it the way it was done. I think the briefing and the testimony both said that it was for the purpose of estate planning, asset protection, and succession planning. And you just explained a little bit about the asset protection part, and I get the estate planning part, but I'm not really understanding how this whole structure is for succession planning, for example, because the businesses are not in the trust. Just the trade secret is.
So I'm very glad that you asked that because I'm sort of passionate about this part of the planning that goes on. So on the succession end of it, my profession is representing closely held companies and their owners, and I've done it my entire career. When they reach the point of selling their company, when I started practice, I worked for a bigger firm that represented international companies that were more focused on the development of their intangible assets and their intellectual property. When I started my own firm, I started representing people like Mr. Pasveer, who really have latent intellectual property in their companies, and they don't know how to display it. For instance, when we reach a point of succession and we're going to go out to a third party and sell it, what closely held owners of businesses always say is, well, I make good money because I work really hard. Well, you work really hard, but Mr. Goshen testified earlier that he not only works really hard, but there is a surprising difference between Mr. Pasveer's entities by way of performance in the marketplace compared to his competitors. That's called a trade secret. That's called we're doing something different, and that's why we perform so well. So when you do structuring like this, and whenever you do a transaction, private equity companies have seen this a million times, this type of structuring. They're used to it, and they do the roll-up. There's one of three ways they go about doing this on a sale transaction. I've been referring to a roll-up, but sometimes they'll do a direct purchase from that children's trust of either the LLC, or they'll purchase the asset straight out of the LLC. But what this does that's so unique is it puts an emphasis on that intellectual property, that intangible asset, and those trade secrets. And so in due diligence, they ask for, these valuation reports, and you put them in the portal for due diligence, or they'll go and get their own. But since you very specifically isolated these assets, just like a big company would do, it draws attention to the fact that you perform at a very high level because of these trade secrets. There's something there that they want. Now, if you're an attorney in private practice, it's a horrible business because it's all goodwill, right? When you leave, your clients go away. They don't necessarily go to the new firm. This is a consulting business, and very much like, when an attorney wants to retire, their succession plan is another law firm or other attorneys, and you need to hang out for a little bit and deliver the clientele. Here, again, if someone buys this company on the succession end, when Mark decides he wants to retire, what's going to happen is there's going to be an earn-out, and there's going to be a delivery of these intangible assets. And what they'll do when the deal is negotiated on the succession plan is they'll say, you're going to have a 5-year earn-out, and we're going to benchmark this customer list. And if it performs at this level, you're going to get paid this. If it's here, you're going to get this. And if it's here, you're going to get that. But it's very directed towards this MPIP entity and the assets inside of it, and it's an integral part of his estate plan. The fact that he's identified it now is a lot better than, for instance, what happened in Martin Ice Cream. In Martin Ice Cream, there was just simply the sale of the business and an allocation of the vendor relationship on a tax form. And the service said, hold on, what is this? We don't understand what you're doing. Here, he's already done the allocation. There's already been a valuation. It's already been paid for in this structure, or he's still paying for it. He's been paying for it all these years. But it's there, it's identifiable, and it's something that can be marketed so that he can retire sooner. He can explain it to people. He can show it to them. And it's something that in their minds looks more like a tangible asset, something that's real. So it's a great question, and as you can see, I'm quite passionate about this part of the planning that goes on with succession planning.
Okay, and just one other, probably far easier question. When did you say that exterior cladding systems was sold?
I believe this was somewhere 2019 or 20.
That's all, thank you.
Okay, thank you.
Thank you, Judge Stanley. I do have one question for appellant. Since appellant didn't make any arguments regarding the nest penalty and adequate disclosure, is appellant still pursuing that argument?
Our argument is that there is no nest transaction, therefore no nest penalty will apply.
Okay, but you're not arguing that the 20% should apply?
No.
Okay, thank you. Okay. Judge Stanley has one more question.
I just was going to follow up on that date. I heard somebody do this in another case, and being that the pandemic came about in early 2020, does that refresh your memory as to when it was sold? Was it sold during pandemic or before pandemic?
It was probably during. I would have to look up the exact date. Yeah.
Okay, thank you.
Okay, and with that, let me just check to see if the parties have any final remarks before we end this hearing. Franchise Tax Board, any final remarks?
No.
Thank you. And appellants, any final remarks?
Just one remark, Judge Lee. We've heard testimony that Mr. Pasveer has been continuing to pay or continuing to report the capital gain on his own 1040 from payments made from the Children's Trust to he and his wife individually. While only tax years 2010 through 2014 have been opened by the FTB, tax years 2015 through 2023 have remained closed. The FTB is perfectly happy to accept Mr. Pasveer's payment of the capital gain with respect to the payments made from the Children's Trust. If some sort of nest transaction were to be found, we'd hope that any sort of payments would be applied against the deficiency from the Children's Trust to Mr. Pasveer as a way with respect to the capital gain picked up.
Thank you. Does that conclude any final remarks appellants may have?
Yes.
Thank you.
Judge Lee, may I ask one question?
Yes.
Please? You're going to issue an order regarding the declaration and then the timeline for asking questions or whatnot?
Yes, I will.
Thank you.
Okay. So, with that, thank you everyone for coming in today. The record will be held open for additional briefing. I will issue a post-hearing order, which will outline the timeline regarding when appellant will submit the declaration regarding the trade secret and appellant's response. Again, thank you for coming in today. Today's hearing in the appeal of PaMaCo Inc. and Pasveer is now adjourned. This concludes all of our oral hearing matters for today. Thank you and goodbye.
Thank you very much.